Welcome to the Live Squawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. Hello, and welcome to Live Squawk's Market Talk Review. This is our weekly look back at the stories and the events of last week that influenced and moved the markets around. We'll also take a look at the upcoming week and the key events to be aware of. I'll be doing this with the help of an expert, market expert, and this week I'm joined by Sam Cutler, portfolio manager at 333 Capital. As I said, we'll look back at last week's key points. There's enough of them to be to fill the whole show, but we will give you a little sneak preview of what to expect from the week ahead as well. Before I do that, a quick disclaimer, as ever. It's boring, but it's true. We have to do it. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We're not responsible for any losses or gains that may result from following the content on this channel. And with that, hi Sam, I want to bring you in there. How you doing?
Hey Harry, I'm good. Should be a good one with last week. A lot of things went down.
A lot of things went down, and I'm still trying to compute everything we saw, really. But that's why we're here, and that's what we're here to do. So let's get cracking with it. Right. Well, I've started with non-farm payrolls from the US, and this month's one was a cracker. Okay, so we were looking for a low number. So do you want to go into that? What are your views on last week's non-farm?
Yeah, I mean, it was at first look, when you first look at the report, it was just really, really ugly number, right? The headline acceptable, if you take it at the margin, right? 70 something K, I believe it was. If you believe, the break-even unemployment is sitting between 80K and 100K, it was a little weak at that, but what really took everyone, I think, is those revisions, right? The revisions were just astronomical. And if you remember the last report, the largest gains there in the state and local government, there was a lot of give back on that. So I think, we kind of have to look and break this down a little bit, because as I dove kind of into the report and kind of looked at the things, we saw really large losses across the cyclical areas of the economy, which really, really doesn't bode too well. And it was very similar to the last print. We had actually negative job gains in the cyclical areas. And the last time we had negative job gains in those cyclical sectors of the economy was in October 24. So those have stayed relatively positive until the last print. And this print was only slightly positive on the cyclical side, but quite a number of bad prints. One thing that stood out to me was this was the second straight month residential construction jobs kicked down. So we also, if you remember it, we got construction spending earlier in the week too, and that fell about 40 bips for the month of June, and the downward revisions was also present for the prior month. So I think this is, a clear reflection of tariffs and uncertainty, which are weighing on investments, which is going to weigh on construction. And then you couple this with the bloated inventories of single-family homes in the U.S., you should assume from here that construction jobs are going to continue to suffer. And on top of this, this was also the third straight month we saw manufacturing jobs post losses.
Yeah.
So if we kind of look at this whole jobs report, X education and healthcare, which have been the major gainers, right? So this print alone was 79,000 in healthcare and education. Right. 79,000 jobs gains versus the print of what? 73,000.
73,000, yeah.
So X education and healthcare, we actually lost jobs in July. And if you break this down just a little step further, you see the majority of it is from healthcare. There was 73,000 jobs added in healthcare, and private education was only about 6,000.
Right.
So last month's gains that we saw in state and local education jobs were completely revised away. those big outsized gains completely revised away. So I think this presents an interesting thing. So remember a while back, we were speaking about the Doge cuts, right? In which most employees received some kind of severance, right? And if you're on severance, you're still going to come up in the survey as employed.
Okay.
So I think it's kind of likely now that we're seeing that feed through of the job cuts that happened in that sector in February and March are now showing up in the payrolls. And I think we see that through the revisions.
So again, this is, we'll try and keep it simple. So the Doge was brought in pretty much off the bat from President Trump's inauguration, and it was, obviously Elon Musk was brought in to make these swinging cuts. And you're saying it's now worked its way through the system and through the numbers to the point now we can see.
I think we're starting to see that. Yeah, I think we're starting to see some of the employees that were on severance now that their severance has run its course, and now they're coming up as unemployed.
Gotcha.
I think a lot of the state and local stuff, because remember, state and local isn't federal. Doge is federal. State and local is government. I'm not sure. Maybe there's some trickle down effect there. I couldn't say for certain, but they're usually separate entities. But I think with the state and government jobs, a lot of this is also in part due to some seasonal adjustments, right? We had some really late school years in certain states like California, New York, and a couple other states had later school years this year. So these employees listed as employed would come out of the data only in July, which I think is what we saw happen in part due to these revisions too.
Okay.
So, I mean, but again, these revisions, you break them down, 2-month net revisions minus 258,000 and 119,000 of that came just from the government sector.
Yeah, listen, if I just go for some of the numbers then. So we've gone over the headline, 73,000, 104 was expected. Previous was 147, revised down to just 14,000. The unemployment rate, which we'll come on to very quickly, rose rounded to 4.2%, which was actually in line with forecast, but there's a story behind that as well, up from 4.1%. We take a look at the average hourly earnings. They came in up 0.3. That was in line on the month versus 0.2 last month. But year over year, we saw 3.9. That's 1/10 higher than expected and a 10th higher from an upwardly revised 3.8% last time around. And as you say, with the manufacturing payrolls, they lost 11,000 on the month. Private payrolls added 83,000, which was below estimates 100,000, and government payrolls actually dropped by 10,000 in there as well. And if we take that non-farm 3-month average, 35,000, just 35,000 jobs versus a previous 150,000 and revised 64,000, previously revised to 64,000, sorry, from 150. So, picking that apart as you've done quite nicely, it just shows there's underlying factors here that's been eating away in the background, and we'll come on to the firing of the BLS chief. But let's go back to that unemployment rate and the number there, because unrounded, it was a slightly different picture, wasn't it?
It was, yeah. And I mean, I just want to make one more point on those private payrolls too, because we did get that net revision right down 139K for the 2-month revision. The bulk of that was in the service providing area, which was at 111,000.
Gotcha.
So to me, that does definitely show some underlying weakness, right? Because we've been making the case that the economy, whatever, it's sustaining okay because of these, tariffs. Sure, people are pulling back on their goods spending, but they're kind of offsetting that with, some of their discretionary spending. Right. But I think if you see private payrolls in the service sector coming negative, I mean, I think that shows that discretionary spending is slowing. Okay. And like you said there, with the 3-month average job growth down to 35,000, if you look at the current estimates of the unemployment break even, it's 80 to 100,000, right? Some are suggesting that the BLS, the birth death model, still could be overstating payrolls by 80K a month. So if you factor that in, I mean, job growth would have been running negative since Liberation Day.
Wow.
Yeah.
Wow.
Yeah. So, I mean, like you said, though, the unrounded UR came in at 4.248, right? So if that just came in at 0.25, you would have had the number rounded to 4.3.
Yeah.
Right. And even at this, the unrounded is up 13 basis points from last month.
Wow.
And not only that, we had the uptick in the unemployment with another tick down in the labor force participation rate.
And the labour force participation rate related to the rounding up of all the
Of like the illegal immigration. We've previously spoken about that. We're seeing them drop out of the labor force because they're afraid to respond as being unemployed. You kind of see that in the household survey numbers where, okay, the labor force is ticking down because employees are leaving the labor force. This time, if you look at the household survey, the non-seasonally adjusted employment decreased by 260K. And the labor force size remained basically unchanged since last month. So this tells us that this time around, the unemployment rate increase was mainly driven from actual employment reduction, not people dropping out of the labor force.
So even more fundamental and again, an underlying issue. Again, this is proper solid stuff here from the job market and the why has this been missed? Why I know you give them the reasons and they're valid reasons. Do you think it was correct then that I mean that Trump's done what he's done, but that he's got rid of the commissioner? What's his name? McIntyre.
Yeah, no, I think that's a terrible, terrible move, right? Because everybody knows that with these government cuts and everything, survey response rates going low, the BLS has had a hard time collecting data. I think collection rates have slid below 60% in the recent months. And I think if Trump does fire the BLS commissioner, I think all that does is essentially create more uncertainty and questions the validity of the oncoming data. So I think in my eyes, this would make it even more complicated for businesses, investors, and policymakers to make decisions.
Well, like you said before, if you got we're coming under 60% responding, how do you base investment decisions on the back of that? Because you're looking at this data and you're just going, well, how much of it can I believe? Look at the revisions.
It's sad, it's funny that we price financial assets and economic policy based on deteriorating data. I mean, I think we spoke last time, like 1/3 of the components in the CPI basket are just guesstimations based on the collected data on the other ones. I mean, it's not great, but at the end of the day, it's the best we got. And my train of thought on this is it's why you can't just look at one print or one data point to give you a clear picture on things. You have to dive down and get into the nitty-gritty details. And
you have to you take it in sequence.
Yeah, you can't just be like, okay, job gains at 100K, cool. Jobs market is strong. There's so much more to it than that. Or like, okay, unemployment rate is ticking down. Cool. Well, what's the labor force doing? What's the household? So you have to look at all these numbers to understand why these things are moving.
Sure.
So I think it becomes a very complex picture, but you're well rewarded if you can put these pieces together because the market, look, it's taking all these things at face value, right? You see equity prices, they've just gone beautifully. We haven't closed under the 20 days since Liberation Day, right?
Yeah.
You get one, bad job sprint, mainly due to the revisions. You'd think, oh, cool, that's going to boost the Fed's chance of cutting rates. I mean, the September FOMC meeting, I think, went from pricing around 40% chance of a cut to about 90% chance of a cut. And what did equity markets do? Equity markets sold off. So to me, a lot of this good news is already baked into these prices. Yeah. So if we start getting this deterioration, I think asset prices they're just priced way too high for this environment. And even if the Fed does cut rates, that's not going to provide a tailwind to markets right now.
Well, that brings me on to the next thing, the FOMC rate decision, because we'll get into how much the market has fluffed this and in terms of built this up and run ahead of the data itself. And we saw the FOMC rate decision. They left rates on hold as expected on Wednesday afternoon. And it was pretty much a dull affair. The only real point of interest was the two dissenters. The first time in over 30 years we've had two dissenters from the board. Bowman and Waller both coming out and dissenting. And in the press conference, Powell said, look, they'll have their opportunities to come out and explain their decision. And they did. It was about 15, 20 minutes ahead of the non-farm payroll on the Friday. So, and if we go over some of the comments, if I can get some of the comments. So Waller, this is some of the reasons Waller gave. Because he concluded that cutting policy rates by 25 basis points was an appropriate stance of policy. Okay. I believe that tariffs are a one-time price event that policymakers should look through as long as inflation expectations remain anchored, which they are. I said the host of data argued that monetary policy should now be close to neutral and not restrictive. Says that while job market looks fine on the surface, other data suggests that downside risks to the labour market have increased. Said that fully respects the views of colleagues on the FOMC that suggests we need to take a wait-and-see approach, but that is very overly cautious. And says sees no reason that we should hold the policy rate at its current level and risk a sudden decline in the labour market. They did put emphasis on the labour market, both Waller and Bowman. Bowman said very similar stuff, really, when she released her statement alongside Waller's as well. What do you make of what they said, and does it ring true with what you're thinking?
I mean, I think so. And I think we touched on this on kind of that FOMC.
Yeah, we did.
We did too. You know, you have people that approach markets differently, right? I think you have Powell, who's done a good job. He's made some mistakes, but he's still kind of, I'll say, afraid to jump the gun because of his previous missteps, right? When he thought inflation was previously transitory, turns out, you know, it really wasn't. And they were a little late to the game on raising interest rates, right? So now I think he's a little afraid to say that, okay, we are in a steady trend of disinflation. These tariffs are going to be a one-time, you know, price level impact. They're not going to be, you know, have any duration of inflation on them. And the labor market at the margin still looks somewhat steady, right? So I think he's afraid to cut preemptively and make another mistake. Now, I see it from Waller's side. My views tend to lean a little more towards Waller, right? There's some clear weakness in the labor market. If you look at everything we've said, not just the headline numbers, you break it down, there's weakness in the labor market. The tariffs have created more uncertainty for business. We haven't seen that come through in layoffs just yet, but we've really seen that on a hiring freeze front. So at the end of the day, do you want to try to be a little bit of the head of the curve or behind the curve, right? Now, the Fed's usually behind the curve. So maybe Waller's now thinking of a different approach. Hey, you know, at the end of the day, if we cut like 25 bips, really what's the worst that's going to happen, right? Yeah. 25 bips isn't going to do a whole lot, right? So it'll appease, you know, the administration. It will also maybe instill some confidence that the Fed has a better grasp on the picture going forward and not just, we're like you guys, we don't know. We're just waiting for the next data print to see what it is, right? So I kind of see his point. I think that would be the safer way to go. But to counter that point too, Trump is a loose cannon when it comes to these tariffs. Like initially we said 10% is the baseline, right? Well, once we got this big list out just the other day, well, it seems like 15% is kind of the...
Yeah. And it's probably a little bit higher than that. I think the average runs at about 17-18%, I think, if you make all the calculations.
Yeah, and then it's okay. And in India the other day, they get this little penalty for this. So it's very hard, again, to just draw a definite picture on how that's going to be. So I can see both sides of the FOMC here, and I hate to sound like them, but look, before the September meeting, we still get 2 more inflation reports and a jobs report. So it's hard to say what they're going to do. I think markets are pricing like an 89% chance of a cut. I think it's, the implied rate there is about 22 basis points lower for the September meeting. Sure. If you do get relatively inline tame inflation reports, they're going to cut by 25 bips. But that employment report, right? It was one employment report. Let's just remember that. It's one data print. If we come in at the next non-farm and numbers are revised higher, that's just like, what does that do now?
Well, listen, having seen what we saw on Friday, there's every possibility, if they're that far out and that inaccurate on the first look, that's a possibility. It is a possibility. Oh, we've been trending lower, but that's a possibility. Let's move on to GDP. The headline number itself came in, as I said, slightly better than expected. But if you break down the numbers, what do you see? There was, I think, business investment wasn't particularly hot. There were some issues. You could pick it apart. But what are your views on GDP?
Yeah, I mean, I think it's a messy picture. It's because of this tariff uncertainty. Like, if you recall the last GDP print, right? It was, net exports, right? A huge drop in Q1 in net exports, which did help kind of pull that figure lower. This quarter, Q2, we had a complete reversal of that on the next exports, which helped, drive GDP higher. So my view, I think GDP is running most certainly below potential, and we're still getting vast distortions from the impacts of these tariffs. And I think that's evidently clear when you look at the net export component. Like Q1 25, negative 4.61%.
Yep.
Q2 25, positive 4.99%.
There you go. Just swinging around. We had Trump talk about it as well and say that Q2 numbers this was on Truth, way better than expected. Too late, must now lower the rate, no inflation, let people buy and refinance their homes. Very simplistic view of the numbers, and if you go by the jobs data and everything, take it all in the round and the inflation picture as well, it's not as cut and dry as he seems to think, really.
No, Powell mentioned that in his speech too, and we spoke about it on the FOMC preview. Like, if you have the economy that's running perfectly fine, and you lower interest rates in the front end of the curve, that doesn't necessarily mean the belly long end is going to drop with them, right? You could easily get a scenario where you cut Fed funds by 25 basis points, and you see the 10 to 30-year sector rise. That's happened before, and that could very well happen again. And mortgage rates are at the longer end of the curve, so you could have a situation where the economy's fine, you cut rates preemptively, Fed funds goes down, and you actually increase the rate in mortgage rates. So you're kind of getting the opposite effect of what you would want to happen. Couple that with, we kind of have an affordability crisis over there in the US. And like I said at the beginning, these single family homes, the inventories are bloated. There's a lot of supply out there, and it's the demand side that's suffering. So if mortgage rates rise because you cut rates preemptively, that's just going to worsen that situation.
So maybe Trump's right in one sense that, bringing business back into the country, trying to reinvigorate the manufacturing sector will get them to where they want to be ultimately.
I think he truly believes that. Again, I'm on the complete other side of that. I think, tariffs kill growth. I think the U.S. we're I say we. I'm not even in the U.S., but the U.S. is it's not a manufacturing country, right? This isn't. We're not producing a lot of that stuff. We have wages are relative to the rest of the world quite substantial. You're not going to have the iPhone manufactured in the US. If you were to manufacture an iPhone in the US, I mean, the retail price of that would be astronomical.
Right. Yeah.
It's just,
doesn't make sense.
I don't see it happening. And, my economic views is that tariffs do hurt growth. I think they hurt the consumer. Ultimately, they're not a tax to the other nations. They are a tax on the consumer.
So again, we're now looking at another side of the household, the US household, that's going to get beaten up a little bit more down the line as well. Then with higher prices and lower productivity ultimately at the moment. So okay, so by all accounts, then we're in for a tasty back end of this year and next potentially, which isn't really being reflected in all the markets as we've discussed in the past as well. Just quickly,
if you think about the first half of this year, right? It was a very, we'll call it a very strong setup. Data was good, but all the revisions were quite negative. So now as we come into the second half of the year, that's why I'm really, really curious to see next month's revisions on payrolls. Are we going to be a flip-flop of that, or the setup is now expected to be very weak data that's revised higher? Or is it actually going to be weak data that continues to, deteriorate and be weak?
These are all questions, at least on my pay grade, but the stocks look a little bit bloated at these levels here at the moment, and could do a little bit of air being taken out.
Yeah, and I will say, just on a positive note, because I know a lot of this sounds bad, like, oh, we have, like, everything's bad, no idea what's going on, it could be this, it could be that.
Mhm.
It creates a mass amount of opportunities in the market, right? If
Sure.
one thing Trump 2.0 has been great for is making macro great again, right? Forget make America great again. Like, macro has been made great again. There is an abundance of opportunities in the markets because of this.
Yeah, and again, I've got to say on the other side, earnings have come in, and I think earnings have been fairly decent. I haven't got numbers to hand here at the moment, but it's not the worst. You look at the earnings season so far, and I think we'll have our guest on from Wall Street Horizon, and Christine will tell us. But even she says in her latest note, the earnings party hits a wall. Strong Q2 profits cannot overcome macro fears, is the title of her latest piece. Says that several S&P 500 companies have been reported, and growth continues to improve, and its EPS growth on the S&P 500 is now around 10.3% annually. So it's not looking too bad on the corporate front, which is probably helping to keep this sentiment elevated really for the stocks at the moment. I want to crack on because we are nearing the end than the beginning. We saw the August 1st tariff postponement as such. Well, basically, they're going to become payable, I think, on the 7th of this week. So those tariffs that were and letters that were sent out prior to August the 1st will come into effect effectively on the 7th, and those taxes will then become due. And even then, even though we were told there's no movement on this, there's no movement on that, there will be more talks, there'll be more discussions. I know that Witkoff is speaking to China, and a number of officials have been out there, even to Russia, talking to Russia about the Ukraine situation, everything. They're very busy people right now, the White House and the administration. So expect more news this week, I guess, on all fronts there. And just finally, Bank of Japan rate decision. They came in, left rates on hold, but following the elections and everything else, there were signs that we could see they were looking to raise rates in the very near future. I think October is being penned as the time frame for Bank of Japan. It's not one of your featured sort of markets, so I'm not going to ask you to look too much on the Japanese situation.
I had the only views I really have on Japan. I run some kind of global bonds models, and JGBs continue to be some of the worst performers on there. So
Right.
It creates some good relative value opportunities as well, right? Because you have some of the worst performing bonds if you look at kind of macro scoring like I do on some of the models. You have JGB and bonds that score the worst. So this does present some interesting opportunities for relative value trades, as if you look at certain European BTBs, bonos, which are the Italian bonds, the Spanish bonds, those are performing extremely well. So there's some interesting relative value trades on playing the spread between those two bonds. And I'm still a firm believer that FX vol is extremely underpriced, especially in the yen. You go out in some of those 1-year options, it's pretty low vol, very reminiscent of fixed income vol in 2022 and 2023, how it exploded. I think we're kind of setting up for some pretty big FX vol here in the future.
Okay, interesting. I'm amazed at how you keep across so much of this. I mean, I'm in the news business. I know what it takes to be across all these stories and market moves. It's just I find it fascinating. Let's move on to the week ahead and to see what we have coming up. It's a very much quieter week, as we are in the midst of summer holidays now and everything else. Everyone's on vacation and so forth. So we don't get a lot of Fed speakers. We don't really get a lot of data out sometimes that's just due to the scheduling and timing. But this Thursday, we've got Bank of England August interest rate decision, expected to cut rates by 25 basis points. That will keep it in line with expectations, really, because they've been cutting on a quarterly basis and looking at the data. Many think that there's no reason for them to move away from that scenario at the moment. So it's really just a matter of the voting and the veracity with which they want to carry on cutting at the moment. So Bank of England, that's coming up this Thursday, and obviously one to watch on that front. Again, the tariff. Sorry, go on.
Yeah, as far as the Bank of England too, I think there's some interesting market opportunities there as well. I mean, if you look at kind of the SONIA curve, which is, the UK equivalent of, let's say, the SOFRs in the US, the market's pricing 2 cuts for the end of this year, right? Okay. But only one more cut in the first half of next year.
Right.
I think that's a little on the low side. So I think there's some interesting opportunities in kind of the flattener space in those SONIAs. I think there's some pretty good value there right now.
Okay, interesting. Again, how touched by what happens in other countries. We make parts for cars that then get shipped elsewhere, and so we are going to feel the effects of what happens to our neighbours and to our other trade partners anyway, as Brits. So yeah, I think you're right. I think it may be a little bit underplayed at the moment, the easing cycle, but they want to remain cautious. They want to remain data dependent to a degree, and that I don't think markets think they're going to change in the near term anyway, unless the language changes on Thursday.
I think that also then sets up potential trades in the currency as well. Like that, there's big speculation on US dollars right now. Is there going to continue to be US dollar weakness? Or, let's say we do get a labor market deterioration, equities sell off. Are you going to get, kind of a safe haven bid back to the US dollar? I think if you're, a little lean on the bullish side in US dollars, I think your best proxy for that is being short cable versus the long US dollars. And then if you want to take it even a step further with the previous comments on, FX vol being extremely cheap on the long dated stuff. I mean, you go look at, some of the, let's just call it some of those cable futures. You go look at some, longer dated 6-month, 1-year puts. FX vols are really low on those. So there's some interesting opportunities out there, like I said.
Yeah, awesome. Okay, and then we have the Canadian labour market report out at the end of the week as well, and the Canadian situation at the moment, they've been clobbered hard by Trump's tariffs. That will start to play its way through as well. They, in terms of rates, they left rates on hold last week, but again, there is a lot of expectation that we are going to start to see rates on the move again. I've got a note from BMO's Shelley Korshik here. It says anticipated Canadian job growth to resume its lackluster pace of around 10,000 in July following June's outsized 83,000 gain. This report will be the first look at how the economy fared in July, so we'll be watching hours worked for clues on whether the better than expected momentum at the end of the second quarter held up into Q3. Our estimated job gain likely won't be enough to keep up with slower labour force growth, so we look for the unemployment rate to return to 7%, matching May for the highest since 2021. 7%. Finally, building slack in the labour market looks to keep wage growth on a downward path. Do you have any views on not so much just the labour data, but where Canada goes from here in terms of policy as well?
I actually do, yeah. So again, in the rates, I rely a lot on my models. I have, a STIR model that was scanning for the past couple of weeks as, Canada rates being, in the top 3 of cheapest rates. So I started to receive the December chorus. And look, the way I looked at it, I think at the time there was about 16 bips of cuts priced into the year end. So I was looking at, okay, your risk, you start receiving these cores for December. Your risk is, your 16 bips. They cut once, it goes to 25. They cut twice, it's 50. And I think the pace, like you said, from that BMO note, it's on point that the pace of population labor force growth has been a lot higher than most expected this year. especially at the start of the year. But I think the Bank of Canada has really focused a lot on inflation, especially with these tariffs as well. And I think it's going to become more clear that, inflation in Canada is coming lower, and they're going to be more concerned with the employment backdrop as this unemployment rate continues to rise. And I think they're going to be a lot more comfortable cutting rates in the second half of the year. So I'm kind of on that principle. I think Bank of Canada will resume cuts in the second half of the year, especially if Trump does hit these tariffs harder with them. That will hurt the Canadian economy. And I could easily see Bank of Canada going another 50 bits this year.
Well, okay. Another 50 bits for them as well. We'll have a look at the trade balance data, because that's out of China, because, they've been the biggest adversary for the US in terms of trade, and that what Trump sees an imbalance. So anything on the China picture at the moment? I've got an HSBC note here that says they expect exports to rise 7.8% annually in July, driven by ongoing trade restructuring and the 90-day reciprocal tariff truce, as well as a low base. Do you have any thoughts on China?
I don't really. It's not a market that I follow closely as much as I should. My big thing here is I don't trust anything with Trump and China, right? And this is the one that keeps getting delayed the most. And I think we need clarity on, even if it's not a deal like all these other ones, they're not really deals, right? They're kind of handshake deals, concepts of a deal. I think we need a definitive answer on how's the trade war going to progress with China, because you go back to 2019, right? There was tons of promises that never came to light.
What will get done between the two sides. As you say, they're very astute, the Chinese, at dealing with these trade issues, and they have this way of working ways around it. As I said, they're very astute at it. So it's going to be a tough nut to crack for the US, because China seems to be playing the game, shall we say, at the moment, and like you say, maybe stringing the US along, but it suits both to get something done.
Yeah, absolutely.
Yeah, excellent. Okay, with that, I'd like to wrap up this episode. The data, as we've seen from last week and this, we've got a lot. I don't need to be that quiet a summer. I think the volume is obviously going to be a little bit thinner, as they generally are over the August period heading into September. But in terms of volatility, I think there is still enough headlines and enough going through to keep people mindful of what's of price action, I should imagine, from here, as I said, until we hit full volume and full activity at the end of August, really. And we got Jackson Hole still to come as well. So plenty of speculation around what might come from there as well. But Sam, listen, thank you very much for your participation.
Yeah, Harry, it's always a pleasure.
I love the detail. Again, you look at stuff that I wouldn't think of looking at, and just break it down for us in a really simple form. So thank you for that. Anyone who wants to take a trial out of the service or read up on our reports, you can go to livesquawk.com. This podcast will be on all the major podcast platforms for you to listen back to have a listen back at your leisure. And we'll bring you another episode, I think, in a couple of weeks, because I think with the summer breaks, a lot of people are off at the moment. But listen in for the next episode. And thanks again for listening. All the best and goodbye. Thanks for tuning into the Live Squawk podcast. Your edge in the market starts here. Subscribe now.